We're going to focus in on those recovering from some of their earlier losses, at least in the S&P, just about flat. The Nasdaq up about 0.1%. The Dow still under pressure, but this comes as investors are focusing on the global IT outage hitting major businesses after a week of downward pressure across the major indices. The Nasdaq earlier this week shedding more than 3% of its value just over the last 5 sessions. So for more on the broader market moves as we close out the week here, we are joined by Simeon Hyman, ProShares global investment strategist, on set with us. Simeon, thanks for being here.
Thanks for having me
this morning. So talk to me about what you think this week means moving forward, right? For me, it seems like an indication that it's time to get a little bit more picky.
Well, we're calling the second half of the year a clear reminder to focus on the basics of asset allocation. Do we know if this small cap thing is the real inflection point? Do we know if a little bit of pullback in tech is it? No, but we know some things from history. As an example, 10 years after the tech wreck, large cap stocks were still in the red, but mid and large cap stocks had long gone in the green. So these are critical reminders that, hey, you can't time the market exactly. And we've all been talking about how cheap everything but the Magnificent Seven is. But don't think about it so much as a market timing thing, but more as appropriate diversification that people may have forgotten about.
Mm-hmm. So what does it mean that investors should be doing now when they see this rotation, what has played out over the last couple of days? How should then they be positioning their portfolio for the remainder of the year?
I think first you have to have appropriate diversification within the equity markets, and that means mid and small and even in international stocks and things like dividend growth stocks that have been left behind for no good reason. But another key element here is the importance of having your fixed income, your bonds be bonds, and your equity be equity, because bonds aren't broken anymore. We now have a 4.25% yield on the 10-year Treasury. If we're wrong, if something goes wrong, felt like Y2K this morning, it's bizarre. But if we have a recession and the equity market retreats, now you can make 10% in your bonds. Hasn't been true in a generation. The flip side of that is make sure your stocks are stocks. Make sure they behave that way. So there's a whole realm of
What
buffer.
does that mean? What do you mean by that?
There are a whole realm of buffer strategies and collar strategies. We used to call them 5 and 5 strategies back in my day. 5% return, 5% volatility. And you needed them when bonds were broken. When bonds had a yield of 50 basis points, they couldn't go up if anything bad happened. So you needed these things, but you don't need them as much now that bonds aren't broken. Take covered call strategies. They're an incredibly well-known, very popular strategy, but historically, traditional covered call strategies have returned 1/3 of the equity market. It's not enough. If you're a little worried about the equity markets, you're 60-40, go 50-50, have a little bit more bonds. Instead, if you're looking for equity and you're looking for equity income, we put out an innovation called ISPY, the ticker is ISPY, by using that new innovation everybody's been talking about, daily options. You can deploy them as a daily covered call strategy, get the income, but also the strategy behaves just like equity. So diversify your equities. Make sure you have the bonds, but make sure your stocks really behave like stocks.
It makes me wonder, though, about the volatility that a week like this showed us, right? I mean, let's look at the month. We're supposed to have this easy summer where we're relaxed into earnings, and then you've got, is Biden stepping down? You've got the RNC, the attempt of the assassination against the former president, and then today the world seemingly stops. Is your solution to that just being kind of diversified and having a little bit of your hand in every single bucket? Or does it need to be even more specific than that when you're picking companies that you think can ride through any volatility?
So here's a very important reminder. This morning I was listening to, earlier on your show, this notion that tech is quality now and it's kind of okay because it makes money and it was all eyeballs and sock puppets back in the day. That was not true at all. People are forgetting. It was the S&P 500 tech sector that was at the top of the heap in '99 and the beginning of 2000. It was making tons of money. So I think the key to managing this risk is to understand that the risk is not necessarily just one of price, but it's also of fundamentals. So you have to look for areas of the equity markets that are likely to have sustainable earnings. That S&P 500 tech sector went from doing incredibly well in '99 and 2000 to actually generating negative return on equity by 2002. And if you're looking for signs of stocks that have more sustainable earnings path, look for ones that are telling you they are. Companies that increase their dividends, they're literally telling you they feel good about the future because nobody ever wants to cut a dividend. It's a lot different than a buyback. Everybody talks about buybacks in tech, and that's telling you a good year was last year.
Simeon, what's your base case just in terms of what ultimately the Fed is going to do between now and year-end, given the data that we do have today? And are we making too much about the timing of the first rate cut rather than focusing on some of those fundamental issues that you've been discussing?
Thank you for serving me up my standard line, which is it's not so much about the Fed. The Fed doesn't matter that much.
And that's still the case.
And why do I say that? It's because if you think about the yield curve, if we had 2% inflation, and we're getting close, if we had 2% inflation, a good guess for Fed funds would be 3, and a good guess for the 10-year would be 4, 4.5. Which one of those already happened? The 10-year is already in a stable place, and it's the long end that drives stock valuations. So is there a little something when the Fed ultimately cuts? Yes, but the normalization of the long end of the curve, in addition to meaning that bonds aren't broken anymore, means that we shouldn't expect a downturn in the equity markets if the Fed's a little late, nor would it likely be a tailwind whenever they do cut.